What if I told you the greatest trade in history wasn't based on charts, fundamentals, or insider news, but on a lie, a shared delusion, a belief that millions clung to until one man called its bluff? In 1992, George Soros made over $1 billion in a single night by betting against the British pound. Not because he had better data, but because he understood something deeper. Markets are not reflections of reality. They are engines of belief. And when belief turns blind, the entire system collapses under its own illusion. Welcome to Trading Psychology Stick, where we decode the mental game behind every winning trade. Quick reminder, nothing here is financial advice, just lessons from the masters who played the game differently. This isn't a video about finance. This is a video about power, about perception, about how one man, trained not in economics but in philosophy, decoded the hidden game beneath the surface of every chart you've ever seen. Soros didn't just play the market, he played the minds of those watching it, and he won, not once, not by chance, but as a method, a philosophy, a system of psychological warfare disguised as investment strategy. So if you've ever felt like you're 2 steps behind in the market, like you're always reacting while someone else is pulling the strings, this video will show you why, and more importantly, how to flip the board. Because in this game, the winner isn't the one who knows the most, it's the one who believes the least, and bets the biggest, at the right moment. Let me show you how. Chapter 1. From Philosophy to Finance. George Soros didn't begin his journey with numbers. He began with questions. In the quiet halls of the London School of Economics, long before he managed billions, he was simply a curious mind wrestling with the nature of truth. What is reality? What if perception isn't a lens, but a lever? While other students chased certificates, Soros chased contradictions. He immersed himself in the work of Karl Popper, the philosopher who dared to claim that absolute truth was unreachable and that every belief we held was just a guess waiting to be disproven. But to Soros, this wasn't just intellectual play. It was preparation. Because one day, those philosophical tools would become weapons in the most dangerous game on earth, global finance. He watched the world through a different lens. Where others saw numbers, he saw narratives. Where others trusted data, he questioned the assumptions beneath it. By the time he entered Wall Street, he already knew the secret. The market isn't rational, it's reflexive. Participants don't just observe reality, they change it. Traders don't just react to price, they create it. The moment you believe the market is stable, you've already set it up to break. So, he built Quantum Fund. But it wasn't just a hedge fund, it was a philosophy lab with capital. Every position Soros took wasn't just a trade, it was a thesis on belief, a wager on when perception would betray itself. He didn't just look for undervalued assets, he hunted illusions. And when he found them, he struck hard. Because he knew. Every bubble starts as a belief. Every crash begins as a certainty no one dares to question. Imagine the courage that takes. Imagine watching the world cheer a booming economy while you dig through their assumptions and whisper to yourself, they're wrong. That's not just intellect. That's defiance. That's mental immunity. And Soros had spent his whole life building it, from hiding as a Jewish teenager in Nazi-occupied Hungary, to reading Popper under candlelight, to studying not just what the market was, but how it thought. This chapter isn't just background. It's a warning, because you're not in a game of numbers. You're in a battlefield of narratives. And if you don't know where your beliefs come from, someone like Soros will trade them before you even know they've been priced in. The man who survived the Nazis by pretending to be Christian learned it early. Reality is negotiable. Truth is what people agree on. And agreements can be broken. Chapter 2. The Theory of Reflexivity. The market is not a mirror, it's a stage. And we are not just observers, we are actors. Every belief we hold about the market becomes a line in the collective script. And when enough of us believe the same thing, it becomes real, at least for a while. This is the heart of George Soros' theory of reflexivity. And once you understand it, you'll never see a price chart the same way again. Soros argued that human thinking is inherently flawed. We never have perfect information. We interpret, assume, project. But in markets, these flawed assumptions don't stay private. We act on them. We buy, we sell, we speak, we react. And those actions feed back into the market, influencing others, shifting prices, confirming our own biases. It's a loop. A belief affects the market, which then validates the belief, until it doesn't. Take a boom cycle. Investors believe an asset is undervalued. They buy. Prices rise. That price rise reinforces the belief that the asset is good. More people buy. Prices rise more. Analysts start publishing bullish reports. Retail piles in. But underneath, fundamentals may not have changed. The price increase is a byproduct of belief, not value. Eventually, reality reasserts itself. The narrative breaks, panic sets in, and the loop reverses fast. This isn't just theory, it's what drives every bubble, every bust. From the dot-com explosion to the 2008 housing crisis to meme stocks and cryptomanias, reflexivity explains what traditional models can't. Why irrational trends persist longer than they should. Why the smartest people still lose money. Because logic doesn't drive markets, emotion does. And emotions obey stories, not spreadsheets. Here's something most traders miss. If you've ever FOMO'd into a position because everyone's buying, you've experienced reflexivity firsthand. That queasy feeling in your stomach, that's your intuition warning you about the loop. Comment below if you've ever ignored that warning and paid the price. Soros saw this pattern everywhere. He didn't ask, what is the market doing? He asked, what does the market believe it's doing, and how wrong could that be? It's subtle, but lethal. He wasn't predicting reality. He was diagnosing delusion. Reflexivity gave him the tools to spot when a feedback loop was forming. Not just a chart pattern, but a psychological spiral. So, how do you use this? You start by watching the story, not the stats. You listen to headlines, you study investor sentiment. You look for euphoria without foundation, fear without reason. When the crowd is confident and the data is contradictory, you've found your loop. And where there's a loop, there's a lie. And where there's a lie, there's profit. But here's the terrifying part. Reflexivity doesn't just explain the market, it explains you. Every time you trade based on what you think others believe, you're in the loop. Every time you chase confirmation, follow the herd. Or hold because others are holding. You're reinforcing a narrative. You're not just in the game, you're part of the system that's shaping it. Quick reality check. The market isn't smarter than you. It's just louder. And sometimes the loudest voice is the most wrong. Chapter 3. Trading the story, not the chart. Most traders stare at candles and indicators, waiting for signals like fortune tellers, reading tea leaves. But George Soros? He couldn't care less about your moving averages. He stared at the crowd. He listened to the narrative. Because he understood something most never will. Price is not the starting point. It's the byproduct of collective belief. And belief is a story. You see, Soros never needed a double bottom or RSI divergence to act. What he needed was tension in the plot. A gap between what the market believed and what he knew would unravel. He didn't just analyze trends, he analyzed illusions. When he shorted the British pound in 1992, he wasn't looking at a chart setup. He was watching a delusion play out on the world stage. The UK was clinging to a fixed exchange rate under the European exchange rate mechanism. But the fundamentals didn't support it. Interest rates were rising, inflation was misaligned, and investors, politicians, were all pretending it could hold. That was the story, and Soros knew how it would end. Because when everyone believes a lie, it's not a market, it's a trap. And the moment reality cracks through, the fall is instant. That's what Soros traded, not the price, the shift in belief. Think about your own trades. How often have you entered because the chart looked strong, because the breakout had momentum? But did you ever stop to ask, why is this moving? What is the story the market is telling itself right now? And more importantly, what happens when that story no longer holds? Pause for a second. Open your watch list right now. Pick your favorite position. Now ask yourself, am I trading the chart or am I trading the story behind it? If you can't explain the narrative in one sentence, you might be the one holding the bag when the music stops. Soros would dissect everything. What's the dominant narrative? Is it founded on fundamentals or is it floating on faith? He'd scan news cycles, sentiment surveys, central bank statements, not to follow, but to find cracks. If everyone believed inflation was transitory, he would ask, what if it's not? If everyone said the bull run is just beginning, he would look for signs that the optimism had peaked, because every chart is just a shadow of a deeper story. And when the story breaks, the chart burns. In one famous instance, Soros shorted Thai baht during the Asian financial crisis, not because of technical weakness, but because he saw through the facade of fixed currency pegs and debt-fueled optimism. Again, he listened to the lie and traded the moment the storytellers lost control. This is the Soros superpower, identifying the mispriced narrative before it unwinds. It requires psychological detachment, the ability to stand apart while everyone else dances to the music. And when the music stops, to strike, not with panic, but with precision. So here's where it gets weird. The better a story sounds, the more dangerous it becomes. Because perfect stories don't exist in messy markets. They only exist in the minds of believers. Chapter 4. The Loop Detector. George Soros didn't wait for the crash to make money. He watched for the buildup, like a hawk circling over a trembling wire. To him, the real signal wasn't a moving average crossover or a candlestick reversal. It was when belief started feeding itself. That was the moment a feedback loop was born. And feedback loops are where fortunes are made or destroyed. But what exactly is a feedback loop? It's a closed system of belief and behavior. The market believes something, so it acts. That action changes price. The price move reinforces belief, which leads to more action, which changes price again. Rinse, repeat, inflate. The longer it goes unchecked, the more delusional it becomes, until one thread snaps, and the whole illusion folds like a paper cathedral. Soros trained himself to see these loops forming long before they became headlines. He knew what to look for: rising prices without rising fundamentals, increased volume without increased value, euphoric sentiment with no room for doubt. It's when the narrative becomes religion, and anyone questioning it becomes a heretic. Take the U.S. housing bubble. The story was, home prices always go up. People believed it, so they borrowed more. Banks packaged debt, sold it as gold. Ratings agencies nodded. Investors piled in. Prices surged, which confirmed the story, which drove more lending, more speculation, more belief. But at the center, rot. Overleveraged families, fake incomes, empty homes. The loop was flying, but it was blind. Here's a fun exercise that might save you thousands. Next time you see a trending asset, count how many times you hear the phrase, "this time is different." That's not analysis. That's the loop talking. Soros would have looked at that housing bubble and said, "This is the textbook anatomy of a loop, not because it's rising, but because it's rising without reason." He would have asked, what keeps this going? What belief underpins this entire system? And when that belief breaks, what happens? You can do the same. Ask, is this move based on actual change or just belief that others believe it? Are people buying because value is growing or because they think others will buy after them? Are headlines reporting reality or fueling it? And remember, feedback loops are not just bullish. Fear creates them too. Panic selling drives prices lower, which confirms the panic, which creates more selling. Watch any flash crash and you'll see it. The loop doesn't care about direction. It only cares about energy. So, how do you trade it? You don't chase the loop, you wait for the break. And to see that break coming, you must become fluent in irrationality. You must learn to read between the headlines, to sense when optimism is forced, when the story is too good, too clean, too uninterrupted, because that's when fragility hides. Plot twist. The strongest looking trends are often the most fragile, because strength built on stories shatters faster than weakness built on facts. Chapter 5. The courage to be contrarian. It's easy to sound brave when the market agrees with you, when every post, every chart, every pundit confirms your belief. But that's not courage, that's comfort. True courage is quieter, it's lonely, and it often sounds insane until it works. George Soros didn't become a legend by following the crowd. He became a legend by betting against it when everyone thought he'd lost his mind. Let's go back to the eve of Black Wednesday. The world believed the British government would defend the pound. Billions were lined up behind that belief. The politicians made speeches. The Bank of England pledged interventions. The press reassured the public. And yet, Soros looked at the fundamentals and said, they can't hold the line. Then he placed a $10 billion short. He didn't just bet against a currency. He bet against a nation's will, a government's pride, a continent's dream of unity. And while the world watched with patriotic hope, he sharpened his blade. That's not technical analysis. That's psychological warfare. And to pull that trigger, you need something no indicator can measure: emotional detachment. The ability to silence the noise, the fear, the doubt, and listen only to truth, no matter how unpopular it sounds. Time for some real talk. You've felt this exact tension before. That moment when every cell in your body screams, "This is wrong," but every voice around you says, "You're missing out." That's not FOMO, that's your survival instinct. The question is, will you listen to it next time? Because here's the truth. The market punishes late thinkers. By the time a story is public, the profit is gone. If you wait for confirmation, you'll arrive with the crowd and die with them. Soros didn't wait. He acted when the belief still felt strong. Because he understood, belief is loudest just before it dies. You've felt this tension before. That moment you saw something that didn't add up. That stock everyone loved but you felt was hollow. That rally built on nothing but hype. You hesitated. You scrolled through Reddit, checked Twitter, looked for backup. But deep down, you knew, and you didn't act. That's the gap. That's where profit lives. Between knowing and doing. Between truth and approval. Soros trained for that moment. He didn't trust emotion. He used journals to write down his thoughts, fears, and hypotheses. He studied history not for price patterns, but for human behavior. He knew, fear is not the enemy, it's a compass. If a trade doesn't scare you, it's probably not contrarian enough to matter. Let me tell you something most gurus won't. Being contrarian hurts. It's not some heroic feeling, it's doubt, wrapped in isolation, served with a side of, what if I'm wrong? But that discomfort, that's the price of asymmetric returns. Contrarianism isn't about disagreeing for sport. It's about betting when everyone else is blinded. It's about holding your line while others laugh, scream, panic. It's about trusting logic over applause. And when the loop breaks, when the illusion dies, you'll be the only one standing. Chapter 6, Black Wednesday, Anatomy of a Break, September 16th, 1992. The day the United Kingdom surrendered, not on a battlefield, but on the currency exchange. The pound collapsed. The Bank of England burned through billions. And standing calmly in the eye of the storm was George Soros, the man who had just made over $1 billion in one single day. But this wasn't luck. This was the final move in a long, methodical game. A game that began months earlier, not on a trading terminal, but in Soros's mind. He had been watching the ERM, the European exchange rate mechanism. Its goal, keep European currencies locked within a fixed range, a precursor to the euro. Britain had joined late. Their economy was weak, inflation high, interest rates unstable, yet their government insisted on defending the pound's exchange rate, no matter the cost. It was a beautiful illusion, which meant to Soros it was a target. He saw the pressure building. Britain was bleeding reserves trying to prop up the pound. Every move they made, raising interest rates, buying their own currency, only weakened confidence further. But politicians, trapped by ego and treaties, kept the fantasy alive. And the market believed them. Until Soros attacked. He borrowed tens of billions in pounds, sold them, reinvested in stronger currencies like the Deutsche Mark. He wasn't alone, but he was the biggest, the boldest, and the most prepared. While others hesitated, he went all in. When the Bank of England raised interest rates to 15% in a panic move, he didn't blink. He knew the fundamentals, knew the loop had snapped, knew the bluff had failed. And when Britain finally exited the ERM, the pound collapsed overnight. The belief was dead. And Soros, he had already cashed in. Let's pause here. You're halfway through understanding how a philosopher became the market's most feared predator. Take a breath, because what comes next isn't just about making money. It's about having the discipline to keep it. But the brilliance wasn't just the profit, it was the precision. He didn't fight the trend, he didn't guess. He diagnosed a narrative, timed its breaking point, and weaponized asymmetry. Risk, limited, upside, historic. It was not a trade, it was a takedown. And the world watched in awe and terror. Imagine the mental clarity that requires, the sheer resistance to noise, the composure to double down while a sovereign nation throws everything it has at you. That's not just strategy, that's spiritual detachment, a level of conviction forged through philosophy, failure, and repetition. And that's why this chapter matters more than the money. It shows what happens when reflexivity meets reality, and the trader is prepared. Because you won't get a Black Wednesday, but you'll see smaller ones, delusions defended, trends propped up by hope. And if you've learned to read the loop, if you've practiced restraint, if you're ready to be hated before you're proven right, then when that moment comes, you won't panic, you'll profit. The UK government called him the man who broke the Bank of England. But Soros didn't break anything. He simply revealed what was already broken. The difference? Timing. Chapter 7. When you're right, go for the jugular. Most traders dream of being right. Few know what to do when it happens. They panic, take profits too early, scale out when they should scale in. They've spent so long preparing for failure, they never trained for victory. But Soros did. He had a rule for that rare moment of clarity. When you're right, don't celebrate. Go for the jugular. It wasn't bravado. It was a principle of asymmetric warfare. In markets, most opportunities are noise. But once in a while, you find one so lopsided, so imbalanced between risk and reward, that it demands everything. That's when Soros didn't just hold his position, he increased it. That's when he pushed all his chips forward, not out of greed, but because the math demanded it. In the days before Black Wednesday, as the pound teetered, most traders were cautious. Soros was not. He increased his short. Again and again. Not because he was reckless, but because he understood the nature of inflection points. The closer you get to collapse, the faster the returns, the steeper the curve, the more fragile the lie. And if your thesis is sound, if you've positioned well, if you've done the psychological work, then pulling back isn't caution. It's sabotage. Here's an uncomfortable truth. Most traders lose money not because they're wrong, but because they're right too small. They nail the direction, but miss the magnitude. Don't be most traders. He knew that most of the market played not to lose. He played to annihilate. Because when reality breaks through, the cascade is fast, and most won't react in time. They'll doubt their thesis, they'll lock in gains, and then they'll watch, frozen as the move accelerates, without them. This chapter isn't just about sizing up. It's about conditioning your mind to withstand your own correctness. Because it doesn't feel safe, it feels lonely. The moment you're right and price finally moves your way, that's when doubt screams the loudest. What if it reverses? Should I just take the win? Soros had trained for that noise. He journaled his emotions, reviewed his logic, prepared scenarios before entry. So, when the moment came, he didn't second guess. He executed. Think about your own trades. How many times have you exited too early, not because your thesis failed, but because your confidence did? How often have you watched a move you predicted continue without you, simply because you feared being too greedy? Going for the jugular isn't recklessness, it's math, married with courage. If you've calculated the risk, defined your stop, and entered with intent, then when the market confirms your bet, your job is not to run. Your job is to press. Listen, I know this sounds aggressive, but here's what's truly risky. Being right about a generational move and walking away with pocket change. That regret cuts deeper than any loss. Chapter 8. Risk is a strategy. Most people treat risk like a ghost in the room, unseen, unpredictable, and something to fear. But to George Soros, risk wasn't a phantom. It was a scalpel, a precision tool, something to shape, structure, and even weaponize. Because in the hands of a master, risk doesn't limit action, it enables it. Soros never bet recklessly. That's the myth. The truth is, every one of his massive trades was engineered with layers of protection. He used stop losses, not as a formality, but as a psychological anchor. He sized his positions dynamically, increasing when probability spiked and cutting when the premise cracked. He viewed cash as ammunition, not as dead weight. And most importantly, he didn't fall in love with any position, even his best ones. His mindset was brutal. It's not whether you're right or wrong, but how much you make when you're right and how little you lose when you're wrong. That's not a quote, it's a life philosophy. And it shaped how he approached every trade, every thesis, every battle. So, how did he do it? First, he always defined downside before upside. He knew exactly how much pain he could endure, financially and psychologically. Second, he adjusted quickly. Reflexivity applied to his own thinking, too. If new information came in that contradicted his thesis, he didn't argue with it, he evolved. He changed his mind publicly, ruthlessly, and profitably. That's not weakness, that's agility. And it saved him millions. Here's where most traders mess up. They manage risk with their emotions, not with math. They'll risk 2% on a mediocre setup, but chicken out on the trade of the decade. Backwards. Always backwards. Third, he never let ego drive allocation. He didn't press harder just because he had conviction. He pressed when the risk-reward ratio exploded in his favor, and only then. When the story broke, the feedback loop snapped, and the herd began to panic. That's when Soros pulled out the blade, not before. Most traders lose because they manage risk emotionally. They cut winners, let losers run, or avoid high-leverage opportunities out of fear. But Soros separated logic from identity. A losing trade didn't make him wrong. It made him free. Free to reassess, free to reallocate, free to strike again. That's why he didn't just survive decades of chaos. He thrived in it. So, how do you apply this? Start by inverting your approach. Don't ask, how much can I make? What's the maximum damage if I'm dead wrong? Build scenarios. Stress test your beliefs. Set rules before the heat comes. And above all, treat risk not as something to reduce, but something to direct. Channel it like fire. Control it like a current. Use it as fuel for asymmetric bets that can change your year or your life. Want to know something wild? Soros once said, his greatest trades came after his biggest losses, not despite them, because of them. Losses taught precision. Wins just confirmed what losses already revealed. Chapter 9. Bias and Belief. George Soros didn't trust himself. That might sound strange for a man who shook entire currencies with a single bet, but it was the very reason he succeeded. While most traders search for confirmation, Soros searched for contradiction. He wasn't just skeptical of the market, he was skeptical of his own mind. Because here's the uncomfortable truth. Every chart you read, every tweet you react to, every position you size is filtered through bias. Confirmation bias, recency bias, overconfidence, narrative fallacy. These aren't flaws, they're features of the human brain. And Soros understood that the greatest risk wasn't in the market, it was in his own perception of it. That's why he kept a trading journal, not just to track entries and exits, but to observe his own thoughts. He would note his initial thesis, his emotional state, even his physical condition. He treated himself like a flawed machine, one that needed constant recalibration. If a trade went against him, he didn't ask, why did the market do this to me? He asked, what did I assume that wasn't true? That humility didn't make him weaker. It made him faster, more dangerous, less attached. One famous example. In the early 1990s, Soros went long Japanese equities, convinced that the Nikkei had bottomed, but shortly after entering, he began to feel a dull pain in his back, a recurring physical signal he'd noticed often accompanied mental tension. Instead of ignoring it, he saw it as a red flag. He reviewed the trade, found cracks in his thesis, and exited. The market crashed days later. His back knew before his brain did. I know this sounds crazy, a billionaire trading based on back pain, but think about it. How many times has your gut told you something your brain refused to accept? That's not mysticism. That's pattern recognition below conscious awareness. That's not magic. That's self-awareness. In the world of trading, self-deception is fatal. You cling to your bias because it makes you feel smart. You ignore new evidence because it threatens your identity. You hold on to a losing position because exiting feels like admitting failure. But Soros detached identity from thesis. A trade wasn't who he was. It was a test, a hypothesis. And when the data changed, he changed with it. Have you ever held on to a trade, not because it made sense, but because you were afraid of being wrong? Have you ever doubled down on a bad position, not out of logic, but out of pride? That's the voice Soros learned to silence, not by fighting it, but by noticing it. Quick gut check. Think about your worst trade ever. Now be honest. Did you see the warning signs but ignored them? Did you know but didn't act? That gap between knowing and doing, that's where fortunes die. He didn't aim to be perfect, he aimed to be present. Reflexivity didn't just apply to markets, it applied to himself. Every thought influenced action, every action influenced outcome, and every outcome influenced the next thought. He was a feedback loop too. And by becoming aware of that loop, he turned his own mind into a tool, not a trap. Chapter 10. Reflexivity in the Modern Market. If Soros were 30 years old today, he wouldn't be analyzing British pounds. He'd be dissecting Bitcoin threads on Reddit, watching TikToks about meme stocks, and reading every word Elon Musk tweets. Because today's markets aren't just reflexive, they're on steroids. Welcome to the era of accelerated belief. Let's take crypto. At the heart of every boom is a story. Bitcoin is digital gold. Ethereum will power the internet. This meme coin is going to the moon. None of those are facts. They're beliefs, narratives. But when millions believe together, the price follows. And as the price rises, the story seems truer. And that truth attracts more believers. Price confirms narrative. Narrative fuels price, the loop spirals, until it doesn't. We've seen it time and time again. The parabolic rise of BTC in 2021, the sudden collapse of Luna in 2022, the AI stock frenzy in 2023, where companies with AI in their name gained billions overnight without a single product shipped. These are not anomalies. They are modern reflexive loops playing out in real time, with retail traders as both fuel and victims. And here's the terrifying part. The feedback loop isn't just faster, it's louder. Social media amplifies emotion. Algorithms serve us what we already believe. Groupthink becomes inescapable. You're not just trading the market, you're inside its echo chamber. Real talk. How many positions do you hold right now because Twitter told you to? Because your favorite YouTuber is bullish? Because everyone knows it's going up? If the answer isn't zero, you're already in someone else's loop. Soros would have thrived here, not because he'd outcode the quants, but because he'd outthink the crowd. He'd ask, what is everyone afraid to question? Where is the story too good, too pure, too clean? He'd listen to sentiment, not for agreement, but for blind spots. And when he saw the loop tighten, he'd sharpen his blade. Let's simulate his thinking with Bitcoin. Imagine the price surging to 100K on mainstream adoption. Everyone believes it's the new standard. Institutions FOMO in. Media coverage floods in. Retail follows. Price doubles again. But underneath, hash rates plateau. Regulation tightens. On-chain metrics weaken. That's the crack. That's where Soros would strike, not against crypto itself, but against the unsustainable belief. You can do this too. Start analyzing belief velocity. How fast is a narrative spreading? Who is still skeptical? Are the fundamentals catching up or lagging behind? Study Twitter sentiment, search volumes, Google trends. When euphoria hits 100%, ask, who's left to buy? Modern reflexivity isn't about valuation. It's about virality. And if you can spot the lie before the crowd, you don't need a perfect model, you need timing. Here's your wake-up call. In 2021, a dog coin with no utility hit 80 billion market cap. Not because it solved anything, but because millions believed in the same joke at the same time. That's not investing. That's reflexivity in its purest, most dangerous form. Chapter 11. Soros versus the rest. In one corner stands Warren Buffett, the Oracle of Omaha, calm, disciplined, armed with balance sheets and patience. In another, Ray Dalio, systems thinker, Bridgewater Titan, master of cycles and correlations. And in the far corner, wrapped in paradox and contradiction, stands George Soros, philosopher, predator, provocateur, three titans. Three radically different lenses on the same beast. The market. Buffett believes in intrinsic value. Buy great companies at a fair price. Let compounding do the rest. He treats the market like a weighing machine. Eventually, it will price things correctly. But Soros? Soros never waited for eventually. He didn't believe the market was a weighing machine at all. To him, it was a hall of mirrors, bending, distorting, fueled by the stories people tell themselves. Dalio, meanwhile, uses systems. He models economies as machines, studies debt cycles, breaks down history into repeating patterns. Brilliant. But Soros would argue, what happens when the machine believes its own output? When models shape decisions that then reinforce the models? That's reflexivity at scale. The truth is, all three men are right, in their domain. Buffett's strategy thrives in stable, slow-moving environments. Dalio's in macro cycles. Soros? Soros lives in volatility, in moments of narrative fracture. He doesn't want stability. He hunts instability. Where others see chaos, he sees clarity. Let me make this practical. When Buffett sees a crash stock with good fundamentals, he buys and waits. When Dalio sees a debt cycle peaking, he hedges systematically. When Soros sees a million people believing an obvious lie, he bets against the belief, not the asset. And that's the lesson. You don't need to pick a camp. You need to understand the terrain. There are moments to be Buffett when valuations are low and patience pays. There are times to be Dalio when long-term debt cycles and macro shifts open opportunities. But when a story overtakes reason, when belief builds its own weather system, then you need to channel Soros. The danger is staying stuck. A Buffett mindset in a reflexive market gets you steamrolled. A Dalio model in a black swan gets you blindsided. Soros's gift was flexibility. He could hold a position, then reverse it the next day if the thesis changed. No ego, no apology, just evolution. So, what's your edge? Are you a numbers purist, a pattern seeker, or can you become a shapeshifter, adopting the lens that fits the moment? Soros didn't hate value, he just didn't worship it. He understood the market is not a puzzle to solve, it's a mood to read, a crowd to observe, a lie to time. And the best traders? They borrow from every master, but copy none. George Soros is known for breaking the Bank of England, but lesser known is this. He also broke himself more than once. He made billion-dollar bets that went nowhere. He backed narratives that never looped. He lost, publicly, painfully. And yet, he survived, thrived, learned. Because for Soros, a bad trade wasn't a scar. It was a scalpel, a tool to dissect his own blind spots. Take Japan. In the late 90s, Soros believed the yen was due for a collapse. The fundamentals were flashing. Deflation, demographic decay, political paralysis. The narrative looked ready to snap. He placed the bet. But the market didn't move. Not down, not up, just sideways. And in that stillness, something else stirred. Doubt. Instead of doubling down or ignoring the signals, Soros did something most traders can't. He stepped back. Not to blame the market, but to examine his own thinking. Was he early? Was he biased? Had he overestimated the reflexivity of the situation? He treated the loss not as a verdict, but as a diagnostic. That's what made him dangerous. Not that he was always right, but that he always reviewed. Here's something nobody talks about. Soros probably learned more from his Japan failure than from breaking the pound. Why? Because success confirms what you think you know. Failure reveals what you actually don't. Most traders run from their failures. They hide them behind excuses, chalk them up to randomness, bury them in spreadsheets. Soros exposed his. He ran postmortems on every large position. He asked, what did I miss? What did I assume? What emotional state was I in? What feedback loop did I believe in, but that never formed? Because here's the hard truth. Sometimes the market doesn't lie. It just waits. And if your ego can't wait with it, you'll destroy yourself, trying to force a climax that hasn't arrived. Soros's greatest trades came not just from boldness, but from the wisdom to exit a broken idea. He didn't hold because he was convicted. He held when the loop was real and cut when the story unraveled, even if it cost him money, even if it made headlines. So, what's your failure process? Do you analyze your losses with the same intensity as your wins? Do you journal your decisions, mark your bias, track your assumptions, or do you blame the market, the news, the manipulation? Drop a comment. What's the most expensive lesson the market ever taught you? Not the dollars lost, but the truth learned, because that's where real edge comes from. Because a loss ignored is a lesson missed, and reflexivity applies here too. The way you think about failure becomes the way failure shapes you. Soros understood this. Every loss was feedback. Every wrong belief was a mirror, and the sharper that mirror became, the fewer delusions survived the next trade. Chapter 13. Building your own reflexive model. You've seen how Soros thinks, how he observes belief like a surgeon, how he times feedback loops like a sniper, how he sizes up when he's right and escapes clean when he's wrong. But now the question flips to you. How do you build your own version of that power? You don't need billions. You don't need a hedge fund. What you need is a mental model, a repeatable, flexible, bias-resistant system that doesn't just chase price but hunts narrative. A lens that can turn chaos into clarity. Step 1. Define the narrative. Before you touch a chart, ask, what is the dominant belief driving this asset? Not, is it bullish? But why is everyone bullish? Is it earnings? A macro shift? A cultural meme? Nail the story. Soros always started here, because if you don't know the story, you'll get trapped inside it. Step 2. Detect the feedback loop. Look for reflexivity in motion. Are rising prices fueling more attention? Are analysts echoing headlines? Is social sentiment leaning 90% one way? That's your loop, and the more self-reinforcing it is, the more fragile it becomes. Step 3. Gauge belief. Strength. Use tools, Twitter sentiment, search trends, options volume, funding rates. Ask, is there anyone left to buy, or has the story already priced in perfection? When belief is crowded, exits are narrow. Let's make this real. Pull up your favorite trade right now. Can you identify the narrative? Can you see the feedback loop? Can you measure belief strength? If not, you're flying blind in a game where vision is everything. Step 4. Design the asymmetric bet. Now that you see the narrative in loop, structure your trade. What's the upside if the loop breaks? What's the cost if it doesn't? Soros never bet without defining his risk. You shouldn't either. Use tight stops. Use partial sizing. Be ready to scale fast, but only when the story cracks. Step 5. Track your own loop. Reflexivity isn't just external, it's internal. Journal your thinking. What are you assuming? Are you chasing or thinking clearly? Did your opinion change because of evidence or emotion? Every trade you take is not just a market call. It's a test of your own bias loop. And here's the twist. Your model must evolve. What works today won't tomorrow. The tools change, the narratives change, the crowd gets smarter or dumber. Your reflexive model isn't static, it's alive. Just like the markets, just like you. Soros didn't build one system and stick to it forever. He questioned everything, especially himself. That's why his edge never dulled, because he never stopped sharpening it. So before we go further, let's be clear. This isn't about becoming Soros. It's about thinking in loops, trading in narratives, and seeing what others miss. Your style, your rules, but with his lens. Chapter 14. Soros Style. Simulation. Let's put your reflexive model to work. Imagine this. It's mid-2025. Inflation is reported to have dropped to 2.1%, just above the Federal Reserve's target. As headlines roar, soft landing achieved, tech stocks soar. The Nasdaq hits all-time highs. Social media floods with takes like, "The bull market is back, baby." Retail traders pile into AI plays. Meme coins moon. Every influencer with a microphone is screaming confidence. But you, trained in the Soros lens, pause. You begin your loop scan. Narrative. The economy is fine. Rates are done rising. AI is the new productivity engine. The crowd believes we've escaped recession, not because the data proves it, but because the price justifies it. Feedback loop. Rising prices lead to rising sentiment, leads to more buying, leads to more headlines, leads to more belief. Reflexivity. 101. But here's the glitch. Underlying economic activity is flat. Corporate profits are narrowing. Layoffs have begun in key sectors. Debt delinquencies are quietly climbing. And now, the simulation begins. You're Soros. What do? You don't short the top blindly. You observe. You track options flow, social media euphoria, divergence between economic reality and asset price. The belief is building, but it's not yet breaking. So you wait. Patient. Precise. Watching for the narrative's first crack. Then it comes. A surprise hawkish Fed statement. One line. Further policy adjustment may be required to ensure inflation stability. The market flinches. Not crashes, just flinches. But you feel it. The tension shifts. The illusion stutters. And that's your trigger. Here's your test. Before reading further, what would you do? Short everything? Wait for confirmation? Scale in slowly? Your answer reveals whether you're thinking like Soros or still trading like the crowd. You short the index, not all at once. You build into weakness. You keep stops wide, but planned. You hedge with long volatility. You don't brag. You don't share. You execute. And when the loop collapses, you press. Not because it feels good, but because the structure demands it. As panic spreads, you press harder. As belief reverses, you ride the wave. And when the story finally turns to fear and retail flees, you close. Profitable, detached, surgical. This is what the Soros simulation trains. Not just to trade a setup, but to stalk a story, to diagnose mass psychology, to strike when the market lies to itself, and to stay silent while it does. So, now it's your turn. Pick a market, find the narrative, detect the loop, write your hypothesis, trade it in paper, journal every shift in belief, yours and theirs. Watch how stories form, how they twist, how they snap. And remember, this isn't about being first. It's about being prepared. Chapter 15, The Final Game. Markets are not machines. They are not efficient, rational, or even fair. They are conversations, loud, messy, emotional. They're stories we tell each other to feel safe in the chaos. And George Soros, he never played the market. He played the story. He was not a chartist, not a value investor, not a trend follower. He was a chess master, anticipating moves not because he knew the board, but because he understood the player. He watched how belief formed, how it calcified, how it betrayed its believers. And then he moved, not always fast, not always often, but always when it mattered. That's the real game. Most traders think it's about entries and exits, about indicators and strategies. But Soros knew. The market is a mirror. It reflects not truth, but perception. And if you can see when that perception distorts, if you can smell the moment the crowd begins lying to itself, you can act with terrifying precision. Every feedback loop is a fable, every bubble a bedtime story, every crash a reckoning. And now, you've been given the tools to read them all. Not just to trade, but to think. Not just to profit, but to detach. Not just to observe, but to anticipate. Because here's the deeper truth. This isn't just about the market, it's about your life. Your thoughts are reflexive. Your emotions loop, your beliefs shape your behavior, which shapes your world, which reinforces your beliefs. You are a feedback loop too. And just like the market, you can learn to trade yourself. So what now? You've seen the patterns, you've understood the loops, you've built the model. You've stepped inside the mind of a man who bet against nations, fought illusions, and profited from psychological gravity. Now comes your first move. Not to copy Soros, but to think like him. To look at your portfolio, your habits, your decisions, and ask, what am I believing right now? That might be false, because every trader wants the edge, but only a few realize. The real edge is self-awareness. The rest is execution. You've just walked through the mind of George Soros. Not the myth, not the headlines, the system, the mindset, the machine behind the man. You've seen how he framed every trade as a narrative, how he listened to the heartbeat of belief, how he waited, calm, patient, ruthless, until the story turned on itself. And then, he didn't flinch. He pressed. You've learned the anatomy of feedback loops, the psychology of crowd delusion, the courage to be contrarian, and the discipline to manage risk like a surgeon. You've built your own reflexive model. You've run simulations. You've stared down belief, not just in the market, but in yourself. Now, it's your turn to play the game. Here's your challenge. Pick one position in your portfolio right now. The one you're most confident about. The one that feels safest. Now, write down the story you believe about it. Then ask yourself, what would have to happen for this story to break? Not the price, the belief. If you can't answer that question, you're not investing. You're hoping. Comment below with your biggest belief trade right now. What narrative are you betting on? More importantly, what would make you change your mind? The most honest answer gets pinned, because honesty is where edge begins. And if this video just saved you from chasing the next bubble or helped you see the story behind the chart, you know what to do. But don't subscribe because I asked. Subscribe because you're ready to think differently, because the crowd is always wrong at the worst possible time. And now, you know why. Remember, you don't need billions to be dangerous. You need clarity. Because in a market of mirrors, the one who sees the smoke owns the fire.